Veterinary care has never been more advanced or more expensive. One minute your dog is running through the park, and the next, a single stumble leads to a torn ligament, an emergency room visit, and a massive bill you weren't expecting. That sudden financial shock is why pet owners are increasingly looking at insurance. But it raises a tough question. Is paying a monthly premium of $40 to $80 a reliable financial lifesaver, or just a long-term drain on your wallet? To answer that, we have to look at how the industry actually operates. Pet insurance does not work like human health insurance. There is no copay system where you hand over $20 and the front desk handles the rest. It relies entirely on a reimbursement model. That means you are responsible for the upfront cash. You have to pay the vet in full at the time of service, file a claim with your insurance company, and then wait for them to mail you a check or direct deposit the funds. This table breaks down what a typical $5,000 emergency surgery looks like in practice. If you're uninsured, you're out the full $5,000. But if you have a policy with a $500 deductible and an 80% reimbursement rate, you pay the $5,000 up front, and the insurer eventually cuts you a check for $3,600. Your total out-of-pocket cost drops to just $1,400. The math here shows exactly what these policies are built for. They are designed as catastrophic financial protection, meant to shield you from massive, unexpected medical shocks, rather than subsidizing your pet's routine health maintenance. Because it's a reimbursement system, there is a distinct advantage. There are no in-network restrictions. You can take your pet to any licensed veterinarian or emergency clinic in the country, and the coverage remains exactly the same. Ultimately, while this model demands you have the cash or credit available upfront, its true purpose is to prevent the worst-case scenario. It exists so you never have to choose between draining your life savings and saving your pet's life, a heartbreaking decision veterinarians call economic euthanasia. To understand if that protection will actually be there when you need it, you have to read the Product Disclosure Statement, or PDS. This is the strict legal rulebook that dictates exactly what illnesses your policy covers and, more importantly, what it excludes. The single biggest exclusion, a standard across the entire pet insurance industry, is that providers will not cover pre-existing conditions. If your pet has already shown signs of a disease, you are paying out of pocket for that issue for the rest of their life. This creates a dangerous trap. If you wait to buy a policy until your pet starts showing signs of aging, limping, or chronic illness, you guarantee that those specific issues will be permanently blacklisted from your coverage. Take a look at this timeline, which illustrates how insurers enforce this using waiting periods. Coverage does not start the day you pay your premium. Typically, there is a 14-day waiting period for general illnesses and 30 days or more for orthopedic conditions. If an illness occurs on day 10, it falls inside the waiting window and the claim is denied. This also penalizes you if you decide to switch providers later to find a cheaper rate. Switching immediately triggers brand new waiting periods. If an orthopedic issue pops up 15 days into your new policy, it gets caught in the fresh 30-day waiting period and becomes a permanently excluded pre-existing condition. Now, some providers might reconsider covering a temporary condition, like a minor ear infection, if your vet proves the pet has been completely symptom-free for a year. But chronic diseases, allergies, and hereditary issues are excluded forever. The mechanics are clear. The value of pet insurance decays exponentially the longer you wait to buy it. The system aggressively rewards early action and heavily penalizes hesitation. When you do decide to buy, you'll generally choose between three main tiers of healthcare plans: comprehensive, accident-only, and wellness. Accident-only plans offer a distinct trade-off. They come with drastically lower monthly premiums, but they only cover physical injuries, like a broken bone or a swallowed toy. They provide zero financial help for expensive chronic illnesses, like cancer or diabetes. On the other end of the spectrum are wellness plans. These are usually add-ons that cover predictable, routine care, vaccines, basic checkups, and teeth cleanings. But wellness plans aren't really insurance. They are cash flow management tools. Because benefits are strictly capped for each service, you will often end up paying more in annual wellness premiums than you would if you just paid the vet directly for the exact same shots. This bar chart illustrates a hidden danger in the fine print called a sublimit. Let's say your dog needs a $4,000 surgery for a tick-borne disease. If your policy has a strict $1,000 cap on tick treatments, that massive $3,000 gap becomes an unexpected out-of-pocket cost. Providers will let you adjust your reimbursement levels, say dropping from 90% to 70%, and let you raise your deductible to lower your monthly premium. But remember, the base price of those premiums isn't flat. Costs scale upward aggressively based on your pet's exact age, specific breed risks, and even the geographic cost of veterinary care in your zip code. Attempting to secure the cheapest possible premium usually requires a compromise. You get a lower monthly bill by accepting hidden sublimits, strict caps, and major exclusions, shifting the financial risk right back onto your own shoulders. To filter through these complex rules, we've built a decision flowchart. This is the Pet Insurance Matrix, and it maps these rigid constraints to specific real-world scenarios. Let's look at Scenario 1, the blank slate. If you have a puppy or a kitten under 1 year old, the optimal path is a comprehensive coverage plan. The trade-off here is straightforward. You will pay monthly premiums for years before you ever file a major claim. But by doing so, you lock in a completely clean medical baseline, bypassing every pre-existing condition trap. Scenario 2 is the unknown rescue. You adopt an adult dog with no previous medical history. Ensuring a rescue subjects you to rigorous record scrutiny. To protect yourself from claims being denied later, you need an incredibly thorough baseline vet exam the day you adopt. You must get clinical proof on paper showing exactly what is not pre-existing before the waiting periods expire. Scenario 3 covers the senior pet, or an animal already managing chronic health issues. Comprehensive policies for seniors are astronomically expensive and riddled with exclusions for the very diseases they already have. The strategic move here is to drop comprehensive coverage, purchase a cheap accident-only plan for emergencies, and self-fund their illness treatments by putting what you would have spent on premiums into a high-yield savings account. As for routine care, only consider wellness add-ons if you struggle with the cash flow for annual exams. Just do the math first to ensure the total annual cost of the premium doesn't exceed the sublimits of the care you receive. Ultimately, purchasing pet insurance is a bet against yourself. It is a financial product that you purchase with the sincere hope that you never actually have to use it. The final decision shouldn't come from a generalized calculation of return on investment. It comes down to 3 things: your pet's age today, your bank account balance, and asking yourself, could you absorb a sudden $5,000 shock tomorrow?